What if I told you that two people each invest $100,000, wait 30 years, and one ends up with millions more than the other? The shocking part isn't how much they invested. It's where they invested. Most people believe real estate always wins because land never loses value. Others swear the stock market is the greatest wealth machine ever created. But here's the truth almost nobody talks about. The answer isn't emotional, it's mathematical. And by the end of this video, you'll know which investment has historically created more wealth, why most people calculate it incorrectly, and the one hidden factor that changes everything. Let's start with real estate. Imagine buying a $500,000 house with a 20% down payment. You invest $100,000, and the rest is financed with a mortgage. If that house grows at around 4% annually, after 30 years, it's worth roughly $1.6 million. Sounds incredible, right? This is why so many people love real estate. You're controlling a large asset with relatively little money. That's called leverage, and it can massively increase your returns. But here's what many YouTube videos conveniently ignore. A house isn't just an investment. It comes with property taxes, insurance, maintenance, repairs, closing costs, and sometimes HOA fees. Replace a roof, fix the plumbing, renovate the kitchen, and suddenly thousands of dollars disappear. Those expenses quietly reduce your real return. Now here's something even more important. Most people compare a successful real estate investment with a successful stock investment, but they ignore the investments that failed. A bad property in the wrong neighborhood can stay stagnant for years. A single expensive repair can wipe out months of rental income. Likewise, buying random stocks without diversification can be disastrous. That's why the real comparison isn't real estate versus stocks. It's smart investing versus emotional investing. The asset matters, but the strategy matters even more. Now let's look at stocks. Imagine investing that same $100,000 into a broad market index fund, earning an average annual return of around 10%, close to the long-term historical average of the U.S. stock market before inflation. Leave it untouched for 30 years. No buying, no selling, no panic. Thanks to compound growth, your investment becomes roughly $1.7 million. Wait, did you notice something? The house reached around $1.6 million, while the stock portfolio reached about $1.7 million. But here's the twist. The real estate example used borrowed money to control a much larger asset. The stock example didn't use leverage at all. That's why comparing them isn't as simple as looking at the final numbers. Now comes the hidden math that changes everything: cash flow. If your property is rented out, tenants may pay your mortgage while the property continues appreciating. That's powerful, but vacancies, unexpected repairs, and bad tenants can reduce those profits. On the other hand, many stocks pay dividends, and those dividends can be automatically reinvested, creating an even stronger compounding effect over decades. There's also a cost that most beginners never think about: time. Managing a rental property can mean answering late-night calls, finding tenants, handling repairs, and dealing with paperwork. An index fund, by comparison, can quietly grow in the background with almost no effort. One investment demands more of your time. The other lets your money work while you focus on your career, business, or family. Time itself is an asset, and smart investors know how to protect it. So which one actually wins? Historically, diversified U.S. stock market investments have generally produced higher average long-term returns than residential real estate. But real estate has one enormous advantage: leverage. If property prices rise significantly, using borrowed money can amplify gains. The problem: leverage also amplifies losses. If housing prices fall, your equity can disappear much faster than you expect. This is why wealthy investors rarely choose only one. They understand something beginners often miss. Stocks provide liquidity, diversification, and effortless compounding. Real estate provides leverage, rental income, and tangible assets. Together, they balance each other's weaknesses. But there's another psychological trap that keeps people poor. Most investors don't fail because they chose the wrong asset. They fail because they quit too early. They panic during stock market crashes. They sell properties during recessions. They confuse temporary price drops with permanent losses. Think about this. If someone invested consistently through every financial crisis over the past several decades, they experienced crashes, recessions, inflation, and uncertainty. Yet patient investors were repeatedly rewarded because markets eventually recovered. Time, not timing, became their greatest advantage. Here's the real lesson. Wealth isn't built by finding the perfect investment. It's built by staying invested long enough for compounding to do the heavy lifting. Whether it's stocks or real estate, consistency beats excitement almost every time. So if you're asking, which makes more money? The honest answer is this. Stocks have historically delivered stronger long-term average returns. Real estate can outperform when leverage, rental income, and smart management work in your favor. The biggest winner isn't the person arguing online about which asset is better. It's the person who starts early, invests consistently, manages risk, and lets time multiply their wealth. Now here's a question that could completely change your financial future. If someone handed you $100,000 today, would you buy real estate, invest in stocks, or split the money between both? Let me know in the comments. Your answer might reveal more about your investing mindset than you realize. And if you enjoy videos that break down money, psychology, and wealth using real numbers instead of myths, make sure to subscribe to Smart Legacy and turn on notifications. I'll see you in the next video.